Some of the knowledge that I have from working in lending and in capital markets to try to transmute that into something that, transitions into something that's tradable. And I think it would mainly transition into if you're trading equities, right? Because this is sort of analyzing a company's financials. And if you are trading equities, right, the fact that you're trading an equity inherently means that it's a public company. And if a company's public, then their financials are also public, free to access for anybody. And you can, just pull those. And if you do have a large position in any individual stock, you're going to want to be familiar with the finances of whatever company you're trading, of course. So here, I won't read this off directly just because, nobody wants me to sit here and read them anything, but you can, pause the slide if you want to. But basically, I will talk about the highlights. 3 uses of cash are paying obligations, investing in working capital, investing in fixed assets. For any company to survive, paying obligations is a must, whether it's paying debt service to a bank, a supplier's invoice, or other creditors. Essentially, what lenders want to see when they're lending people money is that the cash flow, there's a cushion between the cash flow and the debt service, so that, that if there is a downturn in cash flow, that the company's still able to pay or to make its debt service. When looking at a project, several items need to be considered, including the total costs associated with the project, funding sources available, ensuring that cash flow is greater than debt service. The ratio between the net operating income and the debt service is considered the DCR. Going back to what I was saying, lenders want to see a high DCR, right, as opposed to a low DCR, or one below 1-to-1 parity, because if your DCR is lower than 1, that means that your cash flow is not sufficient enough to meet the debt service. And of course, they want to see a cushion there. And whenever you're financing a project, you need to make sure that the total sources of funds matches up with the uses of funds. Sometimes loans need to be restructured. You can have government guarantees that substitute cash for collateral. You can also use subordinate financing, right? If you're the senior lender, subordinate financing is an option because it's a way to finance the project in a way that's subordinate to yourself. And if there's an issue, right, if you need to call the collateral, you're the senior loan, so you'll be able to call that more quickly. Let's see. Annual debt service is measured by the fiscal or calendar year and does not typically change during the term of the loan. It consists of the interest and principal payments due at known regular intervals. That's pretty straightforward, I think. Outstanding principal is capitalized on the balance sheet, and interest payments are expensed on the profit and loss statement, also known as the P&L statement. This just kind of goes through basically different types of intangible assets. Interestingly enough, Bitcoin's actually listed as an intangible asset currently. Although it shouldn't be an intangible, it should be cash and cash equivalent, mark to market. You guys don't really care about amortization. This is important. Current long-term debt is found under current liabilities on a balance sheet because it consists of the current portion or amount of the principal owed on long-term debt within the next 12-month period. Long-term debt is found under long-term liabilities because it consists of the remaining principal owed on existing loans. After subtracting the current long-term debt, it represents the principal balance of the loan that is due more than 12 months. So a good rule of thumb is that any company that runs into issues, and with insolvency, remember, insolvency means that the company doesn't have enough liquid assets to meet its liabilities. So a company that's insolvent could theoretically have a significant amount of assets, but they're just not liquid, right? And a lot of times you'll see that in a company will, basically have a lot of capital tied up in long-term lending, long-term loans that are lent out, or have their capital locked up in some other type of long-term structure, and it borrowed a lot of short-term debt. So a lot of that short-term debt is hitting maturity while their capital on their balance sheet is locked up long-term. Let's see. So this kind of gets into the nitty-gritty of it. You got your gross fund flow, which is your cash flow that's calculated by this equation. You want to calculate the company's profit after tax plus non-cash expenses, which includes depreciation and amortization of any financing. Let's see. This is a good principle to understand. The general process to determining a loan size, and which is what is meant by debt capacity, is by analyzing the cash flow of the company and then working backward from there, right? Because everything flows from cash flow. Let's see. Yeah, this is pretty obvious. Debt service should be less than cash flow. Existing debt service consists of payments on debt that a business is currently repaying. You got your current and long-term principal, current long-term debt. Let's see. Oh, this is what we were talking about earlier. The DCR, the debt coverage ratio, taking the total available cash flow for debt service, adjusted cash flow, and then dividing it by the debt service. And to find your total debt capacity, you take the total loan amount and multiply it by the constant, which is a kind of a detailed formula that I don't really want to dive into, but basically the idea here is that you get to the total loan amount backwards by working with cash flow as a relationship to debt service. And that's how you decide the structure. Whereas opposed to, a lot of people might not realize that, right? They think that that you sort of start with the loan amount, but that's not really how it works. So cash flow consists of all cash available for distribution before taxes and after paying all expenses and debt service. To calculate cash flow, subtract the total debt service from the net operating income. Net operating income minus debt service equals cash flow. And net operating income equals the estimated gross rents. In this case, this is for real estate. But, you could replace estimated gross rents with the income for a company that's not a real estate company. So net operating income is estimated gross income minus operating expenses minus reserve deposits. We already talked about this. Let's see. Now we're getting to adjusted cash flow analysis. I don't want to get too in depth on this. Kind of scroll through it. This is more relevant to, real estate in particular. Vacancy consists of the total income that is projected to be lost due to vacant residential or commercial space in the building. The vacancy rate is the converse of the occupancy rate. So, and this is pretty obvious, 10% vacancy rate equals a 90% occupancy rate. Vacancy allowance is the vacancy rate multiplied by the gross income. So that's really, that's really how much leeway you have with your vacancies until you start running into issues. Return on equity is a common measure of rate of return in real estate based on pre-cash tax flow as a percentage of invested equity. To measure the rate of return on owner equity, you need to divide the cash flow available by the total equity the owner invested in the project. This is just a way to, typically when you structure these deals, you have the developer, whoever's developing the real estate, putting down like a certain percentage of the equity, but it's usually a small percentage. Usually the debt is usually you have something like, the project is financed like 60% by the senior loan, 20% by the developer's equity investment, and then maybe like 10% by a subordinate loan and 10% by like some other type of guarantee, maybe by the developer as well. So cash-on-cash ROI, COC ROI, identifies the percentage of the return from pre-tax cash flow on the owner's equity investment into the project. Again, we just talked about that. We've already talked about lender ratios are used to determine debt capacity at the project level. When the word project just means real estate. Project costs are financed by a combination of debt and equity. Structuring attractive real estate loans requires a deep analysis of proposed debt and equity to ensure that both lenders and developers are satisfied with the level of risk and reward on their investments. It's important to understand what DCR is. DCR measures the cash available to service debt plus a margin of safety, or the lender's income cushion. DCR is the ratio of the net operating income to the total debt service. We've talked about this before. Lenders prefer DCR somewhere between 1.15, 1.1, or 1.35, which indicates that for every $1 of debt, the borrower has, significantly more of cash available to service that debt. The LTV ratio is the measure of a lender's collateral risk. It means the loan to value ratio. So you basically take the loan and divide it by the value of the land. But if you're using an equity, a company, you just take all the total outstanding debt that the company has taken out and divide it by the value of the company. And there's your, that tells you how leveraged the company is. And that gives you an idea of how much collateral cushion there is between, the property's value or the company's value in another case and the original amount of the loan. Let's see. We already talked about that. Generally, lenders look for LTVs between 70 to 80, with 75% being the most common. When you get closer to 100%, you start being, incredibly leveraged. And again, lenders will typically have a maximum LTV. What can happen in like a financial crisis is, lenders have loan books that have an LTV maximum. And in a crisis, the value of the collateral can drop, very, very aggressively. And of course, the loan values, remains fixed and the value of the collateral is dropping. So you get a situation where these lenders have loan books where all of a sudden, like a significant portion of the portfolio has LTVs that are way above the maximum, right? And then you get into, that's really a bad scenario. To utilize the DCR ratio to calculate the maximum loan amount a lender will finance based on the minimum DCR requirement, restructure the formula to calculate for debt service. So debt service equals net operating income divided by DCR, and then you solve this for debt service, right? You divide net operating income divided by the DCR ratio, and you divide the debt service ratio by the loan constant. Again, which I don't want to get into depth about what the loan constant is, but it's just an underwriting formula that, each company has a different underwriting formula. Small business loans are pretty popular, especially during the pandemic. There's certain qualifications that you need to have to be able to qualify for small business. You need to, be operating a business, obviously, be organized for profit. You can't be a nonprofit. You got to be local, located in the United States. You have to be able to demonstrate some type of need for the credit, meaning that, the company's, needs help financially. And you also need to not exceed the business size requirements so you can't be, obviously it's a small business loan, you can't be a massive corporation applying for a small business loan. Here's just a different, you got your SBA 7A, Standard Certified Lenders Program, CLP, Preferred Lenders Program, PLP, SBA Express Loan, Pilot Loan Programs, SBA 504, Prime Loans, 7A Special Purpose Program Loans, Disabled Assistance Loan, low-income individuals, you get the idea. Energy conservation, export working capital loan, employee stock ownership, pollution control, defense economic transition assistance, cap lines program, builders loan program, American Recovery Capital. SBA 7A loans serve as a critical purpose for both small business owners and the community at large. Small businesses receive assistance with long-term, lower down payment financing. SBA guarantee reduces risk for the lender. That means that, these small business loans have government guarantees which reduce the risk, at least individually. And theoretically, the loans promote economic industrial growth within the community. Let's see. So, looks like, the small business loans are obviously going to be, a little bit smaller than your typical loan because they're small businesses. While they need financing, they don't need the type of financing that a larger corporation would need. So we'll kind of skip through that. I mean, you kind of get the idea. Let's see.